So we're kicking off chapter 8. We're moving beyond the assets, and now we're going into liabilities. So liabilities are a big part of intermediate accounting, so we only really touch on them here. And so in this chapter, we're pretty much going to cover the vast majority of the liabilities. Next chapter, we'll talk a little bit about some of the long-term liabilities, because here we're going to just focus on current and contingent. So let's get started. So here are our learning objectives. We want to figure out the difference, distinguish between current and long-term liabilities, which is kind of what we've talked about before. We'll talk about analyzing accounts payable turnover, right? So first, how we account for accounts payable, and then analyzing accounts payable turnover, which is another one of those turnover ratios. We've already done a couple of them for inventory and accounts receivable. Then we're going to talk about how we account for notes payable. That's where we have interest as a component, right? Accounts payable don't usually accrue any interest. And then we'll look at accrued liabilities and unearned revenue. And finally, we'll talk about something called contingent liabilities. So these are liabilities, for example, where the company does something bad and there probably will be a lawsuit coming up, but nothing has happened as of this moment, right? But we still need to maybe disclose it. So we'll look at the circumstances for contingent liabilities. So again, if we look at the balance sheet, we've kind of already talked about this asset section, and now we're in this section of current liabilities. We're going to talk about long-term liabilities next chapter, so this is going to be chapter 9. But right now we're kind of in this section where we look at current liabilities. So things like accounts payable, accrued expenses, and unearned revenue. So first, the difference between current and long-term liabilities. Just like you would imagine, a current liability is a debt where you're going to pay in cash usually within 1 year, or an operating cycle if longer. So again, a company like Boeing has a very long operating cycle because they build things like airplanes, which take a long time. Current liabilities normally deal with various day-to-day operating activities, right? You're buying supplies, you're buying inventory on account, things like that. That's how these employees work for you. So you accrue an expense for employee salaries. These are kind of day-to-day business activities. If the debt is going to be due more than 1 year from the balance sheet date, then it's going to be a long-term liability. So here's an operating activity and the current liability that usually comes around of it. So buying things like inventory, supplies, paying operating expenses on account, you're going to have accounts payable, right? You might borrow some money for operations, generally note payable. This is for short-term borrowing, a few months, 3 months, 6 months, 9 months, things like that. And you'll accrue some interest when you're closing your books, right? Remember from chapter 3, we have accrual accounting, so we'll accrue some interest. We have to pay employees, so you'll accrue things like salaries, wages, payroll taxes payable. We may need to pay income taxes, so you'll accrue income tax payable. You might have to fulfill warranty claims, right? So we might have to accrue warranties payable. And we may process advanced cash payments from customers. This is one we've seen before, unearned revenue. Again, it has the word revenue in it, but it's a liability because we receive the cash before we satisfied the revenue requirement. So we can't recognize revenue until it's earned, and we haven't earned it yet. So it's unearned revenue, a liability. So how do we account for accounts payable? And let's analyze accounts payable turnover. So again, this is another one of those turnover ratios. We've already done one for accounts receivable and inventory. So hopefully these are slowly starting to make sense. So accounts payable are you owed when you buy products or services on account, right? So we've seen this now through many chapters. And you can see for Amazon, as of December 31st, 2016, accounts payable was $25,309 million, meaning around $25 billion. So this ratio, accounts payable turnover, it measures the number of times a year the company is able to pay its accounts payable. Again, I always find the turnover ratio to be a really clunky thing to try and explain, right? It doesn't make intuitive sense. So we generally want to express it in days, which we'll do here. So accounts payable turnover is your purchases from suppliers. We assume that all of them were bought on credit, so on accounts payable. Those are the purchases from suppliers for throughout the year. And those are going to be divided by your average accounts payable, which again is just your beginning plus ending divided by 2. And then we're going to do it in days by taking 365 and dividing it by this ratio, turnover ratio we just computed up here, right? And so that will give us days payables outstanding. So first, this purchases from suppliers, this thing right here, right, that we need to figure out. This is the problem. This is actually not on the company's financial statements. There's nowhere. You have to compute it. And here's how you can compute it. You're going to look in your inventory T account. Your inventory is going to have a beginning balance and an ending balance. If you remember back from our inventory accounting chapter, on the credit side, you know inventory gets decreased when you have cost of goods sold, right? This is an expense. You debit cost of goods sold, you credit inventory. So the amount of cost of goods sold is the same amount that inventory decreases by. The difference to get from beginning to ending, and you have cost of goods sold, the difference is going to be your purchases from suppliers, okay? So here's another way to look at purchases from suppliers. And again, we assume all of it's on credit. It's your cost of goods sold plus your ending inventory minus your beginning inventory. This is just an equation based on this information up there in the T account. So take a moment on this page, make sure this makes some sense. It takes a little bit for this to sink in. If there's not a material difference between beginning and ending inventory, then really we don't have to adjust for inventory amounts. What does that mean? Well, if cost of goods, if your beginning balance of inventory was 100 and your ending balance was also 100, does it really matter what this, basically these two would be equal to the same, right? In order for beginning to be 100 and ending to be 100, cost of goods sold, let's say it was 5,000, well then that means purchases from suppliers must have been 5,000 as well, right? So that's what this is basically saying, is that we can just ignore this different inventory amount if there's not a material difference between beginning and ending. So we would just divide cost of goods sold by average accounts payable to get accounts payable turnover. Then we would take 365, divide it by the ratio we just computed up here, and that would give us days payables outstanding. The average number of days it took the business to pay its suppliers' invoices. So you as a business, if you have an account payable, how long before you paid the money you owed to one of your suppliers? So let's look, this is looking at a specific company, in this case, Amazon, okay? So we can see here, let's do 2016. So cost of goods sold was 88,265. And here there's a difference. Again, beginning inventory and ending inventory are very close to each other, so we could kind of just ignore this. But for the sake of completeness and accuracy, we also take this change in inventory. So it must be that you purchased 89,483. Why? Well, again, go back to your inventory T account. If beginning was how much? 10,243, and ending was 11,461, and your cost of goods sold was 88,265. How much was your purchase from suppliers right here? Well, it must have been 89,483. So if that doesn't make sense, just go back and revisit how you do this analysis within the T account. So anyway, divided by average accounts payable. Again, this is just beginning plus ending divided by 2. Okay, that's how we get that. That gives us our accounts payable turnover. Then we're going to take 365 days, divide it by this number, and that's going to give us 93 days. So Amazon roughly takes 93 days to pay its suppliers. How does that compare? So again, that in absolute terms, that doesn't tell us much. How does that compare to other stores, specifically retail stores? Well, Walmart takes about 40 days to pay its suppliers, and Target takes about 55 days to pay its suppliers. So here's a question for you. If you were a supplier of either Amazon, Walmart, or Target, right, which would you rather do business with, looking at this ratio? Well, Walmart, right? If I'm the supplier, I want to get paid as quickly as possible. Walmart, on average, pays accounts payable in 40 days. Target is 55 days, and Amazon is 93 days. So generally, a high turnover ratio is better, right? Companies that have shorter payment periods tend to be better risks. It's not always the case. Sometimes the sign of taking longer to pay your suppliers is that you have some financial stress. But sometimes the sign, like, does Amazon really have financial stress? No. Amazon is just so powerful that, frankly, they can take as long as they want to pay you. If you don't want to wait, don't do business with Amazon. But that's a problem, right? Amazon is really powerful. So sometimes this is not a sign of weakness for Amazon, but rather a sign of strength. And this is why financial analysis is a job or a career that really requires a lot of brain power, because there isn't always obvious answers as to whether something is good or bad. So let's look at notes payable and accruing interest. These are very similar to accounts payable, but they tend to be more formal, right? So notes payable tend to be a written contract that have a specific interest rate, even though the interest and the principal gets paid just at the end of the period. So you don't pay interest usually like every month or something, because these notes are only usually 1 to 12 months long. These are still current liabilities, right? So you'll only pay interest at the end when you pay back the principal. So again, it's a written promise. Accounts payable tends to be more just a business understanding. This happens to be a written promise that you're going to pay a certain amount of money at a given date with interest. Okay, these are short term, right? You're usually going to pay them off within 1 year, or again, an operating cycle like Boeing will have a longer operating cycle than 1 year. And very often this gets used to finance business operations. So companies will use short-term notes payable for something called working capital. So let's do the accounting and show. So let's say January 1st, 2018, we buy some inventory for $8,000, and it's going to be with a short-term note payable due in 1 year, and the interest is going to be 10%, right? So basic journal entry on January 1st, we buy inventory for $8,000. We debit inventory for $8,000. We pay for it with a note payable. We credit notes payable short term for $8,000. So this is just purchasing inventory by issuing a note payable. What happens? Assets go up, the inventory, liabilities go up, notes payable. Short-term liabilities, because it's 1 year or less. So in this case, we're going to say that this company's fiscal year ends September 30th. So they're closing their books. They need to do their adjusting journal entries at the end of the period. So the company must accrue interest expense, right? Remember chapter 3? Remember that one? Yeah, it's coming back here, right? So at 10% for January through September. So the note payable is $8,000. We owe 10% per year, but only this is from January 1st until September 30th, so only 9 months out of 12. So we need to accrue interest expense of $600, and we have an interest payable of $600. Again, we're not going to pay this interest until we pay off the loan at the end of 1 year, but we must, as we close our books, we must accrue what we owe already. So this is accrual of interest expense at year end, and our year end in this case is September 30th. So what happens? We expense, our retained earnings goes down by 600, or stockholders' equity goes down by 600 from this expense, and we increase our liabilities from this interest payable, right, by 600. So what happens January 1st, 2019, when this note finally matures? Well, we need to write it off. So this is a liability. We're going to debit it to write it off. So we write off the liability. Okay, we have to write off this other liability, the interest payable that we accrued in this slide right here, right? We need to write this guy off. So that's what we're doing here. We need to show another 200 of interest expense that we haven't accounted for yet. And then we show the cash that goes out. We're going to pay the principal plus the interest, 8,800. So this is the payment of the note and the interest when the note matures. We'll also have a current portion of long-term debt. So you might have long-term debt that's due over 10 years. Well, obviously part of that debt is likely to be due within the next year. Think of a mortgage or a car loan, right? So if you have a 5-year car loan, some of that debt is due in 4 years, but 1 year of it is going to be a current maturity, right? So any amount of the principal that's going to be payable within 1 year is going to be a current liability. Right? This is a short-term or current liability. So at the end of every year, the company needs to reclassify, so change from long-term debt to current liability, the portion of the long-term debt that must be paid within the next year. So let's look at accrued liabilities and unearned revenue. Again, reminder back to chapter 3. I told you guys, chapter 3 is a key one. It's going to keep coming back and back again. So what are some liabilities that are associated with some of these expenses up here, right? Well, things like sales tax, commissions, those are accrued liabilities that when there's a point of sale, you have to recognize them. Things like salaries and rent are accrued liabilities that when the period ends and you're doing an adjustment to the financial statements, you need to show them, right? So let's look at sales taxes payable, payroll liabilities, and accrued warranties. So sales tax payable. If you go to Home Depot and make a big purchase, let's say $200,000 worth of stuff, right? So I buy from Home Depot $200 worth of stuff. I have to pay them not only $200,000, but sales tax. Assume that there's sales tax of 5%. So I'm handing Home Depot $210,000 of cash. But Home Depot is only going to show $200,000 of that as revenue. The other $10,000 they owe to the government as sales tax payable. It's a liability. So you handed them some cash. Home Depot is simply the middle person handing the $10,000 from you to the government, right? And so this is recording cash sales and the related sales tax. So again, you're going to owe Home Depot is going to owe the government $10,000 of sales tax. You gave them $210,000 of cash. They sold $200,000 worth of stuff. What about payroll liabilities, right? Many of you work, most of you in fact probably work, so you are on somebody's payroll, okay? This is also called employee compensation. If it's a service organization, this is probably the biggest operating expense that they have. So things like salaries, wages for somebody who's paid an hourly rate, right? Salary for somebody who gets paid monthly or yearly, commission, right? Sales employees that get a percentage of sales that they sell, a bonus, right? So sometimes your employer pays a bonus. So how does this look for an employer? So here's how it looks. They might pay you, the employee, $8,000. That's what your paycheck might be, right? But the expense to your employer, your boss, is more. It's going to be like $10,000. Why? Well, they also they withheld some taxes, some income taxes from your paycheck. So they're going to owe that to the government. They got to send that over to the government. And they also withhold other taxes, in this case, FICA, things like Social Security and Medicare. So they withhold that. It's also a liability. See, both of these are payables. Your employer has to give this to the government, right? And they just have the $1,200 and $800 that they withhold from your paycheck. They give you your paycheck of $8,000, but the total expense was $10,000. That's how much it cost them to have you as an employee, essentially. So again, salary expense is gross pay, but when you have salary expense, you also get some additional liabilities. In the employee's income tax that's withheld from paychecks, the FICA tax payable, this is Social Security and Medicare. So FICA is 6.2% of your gross salary up to 127,200. This is now higher, by the way. This is outdated. It changes, even though we're in 2019, this is still the 2018 number, so it'll go up. Medicare tax is 1.45% of gross salary. There is no limit. So here there's a limit. Here there is no limit for Medicare. And then you'll have salary payable. That is your net pay that you're going to get in your paycheck. And then there may be a bonus, any amount above that. Let's talk about accrued warranties. So this is another one of those estimates that we have to do, right? If we sell something that has a warranty tied to it, a warranty, by the way, a guarantee, means that the company will repair, replace, or provide a refund if the product is found to be defective within a certain period of time. So what we need to do, we don't know how much of our items will come back as warranty expenses. So we need to take the warranty expense now, the same period that we record the sales revenue. That means we have to estimate the warranty expense and the related accrued liability. So again, we're going to do one of those buckets like we created for bad debt expense back in when we were doing accounts receivable. Very similar thought process. So here's an example that hopefully makes more sense. Suppose that Black & Decker, they make tools, sold $100,000 worth of stuff that had product warranties to it. Assume that in the past, they found that between 2 and 4% of the products were defective. So a fair estimate would be that 3% of these sales are going to require replacing the items. So the company, Black & Decker, is going to estimate a warranty expense of $3,000. Just 100,000 of sales times the 3% that are expected to come back, and this is what you'll do: warranty expense of $3,000, accrue warranties payable $3,000. So again, no item has come back under warranty yet. We're creating an estimate and creating a bucket that we can pull from. So now we've accrued our warranty expense. So what happens? Suppose that from those $100,000 of sales, we get $2,800 worth of warranty kind of returns, or whatever you want to call it, right? So what we're going to do, in this case, we're just going to replace the defective products. So we are going to write down our accrued warranty payable. Again, no expense. We took the expense here in this previous period, right? So now we're just going to pull out of this bucket called accrued warranties payable. We had 3,000. We're going to pull 2,800 out of it, so we have another 200 we can still utilize. So, and in this case, we didn't give the customer cash back. We simply swapped it out for a different item, so we took it out of inventory. So we replaced defective products that were sold under warranty. And then let's look at unearned revenues. So these are also, you'll often hear them as deferred revenues or revenues collected in advance. This means that the cash was received from the customer before you earned the revenue. Okay, when this happens, you incur a liability. You have an obligation to provide goods or services in the future. So suppose that June 30th, 2018, Amazon collects $3 million of one-year memberships to Amazon Prime. So if I pay Amazon for my Amazon Prime membership, I expect to get a full 12 months of Amazon Prime membership, right? So Amazon collects this cash, but it's going to be unearned revenue because this was cash in advance for these one-year memberships to Amazon Prime. So they have a liability, unearned revenue. Every month that passes, they earn, really every day that passes, they earn part of this $3 million. And so here's what happens. So this was back on June 30th. Let's go up to December 31st. And 6 months has passed, so we're going to recognize half of that service period, right? So we're going to decrease our unearned revenues by 1/2 of 3 million, which is 1.5 million, and we're going to show it as revenue. Half of 3 million is 1.5 million. So now we've earned the revenue. So our unearned revenue went down, and our service revenue, we can show now 1.5 million. Finally, let's talk about contingent liabilities. So what is this? This is a potential liability that's going to depend on some future outcome of past events. So things like lawsuits, tax disputes with the IRS, if you violate environmental protection laws as a company, right? So you likely will have some potential liability, but it's a future outcome that is uncertain. So what do the rules, the FASB, what guidelines do they provide for accounting for these types of liabilities? Well, you're going to accrue, think journal entry. So you're going to actually show it on your financial statements. You're going to accrue this liability if it's probable that the loss will occur and the loss can be reasonably estimated. Not 100% clear here, right? Take some judgment. And this is important to understand. A lot of times in accounting, you have to make some judgment calls. Make sure to not get yourself in trouble. Make sure you feel really comfortable with the judgment call you're making. If a liability is reasonably possible, but you may also not be able to, or you just you can't put a number on it or something like that, you'll just want to disclose it, right? Disclose it means write a footnote. You'll see, we'll do it on the next slide. You're going to see an example of a footnote where you're just disclosing a contingency. So there's no journal entry, but you're going to put it in the notes saying, hey, this happened. We think this could lead to a lawsuit where we lose some money, but we don't really know the details. If something is unlikely to occur, don't put anything down. There's no need to report it. Don't put it in the footnotes. You don't want to make messes. You don't want to, there's a difference between something being likely to happen or could reasonably happen and something that's unlikely to occur. But again, it is a judgment call. So here's an example. This is note 7 of a 10K, commitments and contingencies legal proceedings, right? So in this case, this is Amazon's financial statements, right? So Amazon.com 2016 financial statements. And they're saying that in May 2009, Big Baboon Inc. filed a complaint or lawsuit against Amazon and Amazon Payments for patent infringement in the district court in the Central District of California. So this company sued Amazon and Amazon Payments specifically for infringing on some patent that Big Baboon Inc. had. And so you can read through this and it tells you and it shows you that, an estimate of the amount of loss or range of losses is not possible. So we're just putting this in the footnote, right? It is reasonable that we might lose this lawsuit, but we don't have a good way to judge how much we'll actually lose. So anyway, that was current liabilities. We're going to dive in Chapter 9 into long-term liabilities, which are really bonds and long-term